Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. I have two trades that I want to look at today. I don't know if you've heard, but a small little company called NVIDIA is going to be announcing earnings after the close today. Seems like the market has been just hanging around waiting for this earnings report so that they can move on with their lives. And that's the kind of the way that the approach has been. Now, NVIDIA, I don't know, NVIDIA, Apple, they all can have a tendency to sell off after earnings and then bounce eventually. People try to take the upward growth in the stocks and take advantage of the earnings report and take that as a time to sell. But NVIDIA has kind of been beaten up a little bit lately, along with the rest of the AI world. Everybody's starting to question the spending. But one thing that AI has definitely done is it has propped up the markets. And it's almost like government stimulus, all the money that's going into and all the mergers and acquisitions across the board that are keeping all of these companies afloat. And we saw that when we got into October, hardly any volatility, hardly any down move. Kind of have a little bit of a sell-off right now, but it's still not even that egregious. And we still get the VIX index, is showing the uncertainty in the marketplace, hanging up, flying above the 20 handle. And an interesting trade actually might be in the VIX, with the VIX at 23 right now, 22.95 at this moment. Maybe getting a little bit of short VIX as we try to get into, the holiday sell season. Everybody talks about the Santa Claus rally, which is between Christmas and New Year's. A lot of people claim that that's more about portfolio management and has a tendency to drive the stocks up. But, past performance is definitely not a guarantee of future results, especially with the Santa Claus rally, because we've seen just within the last couple of years, we've seen a big sell-off in that time period. But in general, this is usually a happy time. We're in the holidays, eat, be merry, put on the Christmas 10 pounds and enjoy life, and then hit the gym on January 1. And so I don't mind getting short some of the VIX, but the markets are scary. The things are scary just in general in the marketplace. What's going on with the Fed? Are they going to lower rates? Are we worried about inflation? Are we worried about unemployment? And I think there's a little bit of both there. So AI has, the companies try to say that AI is not affecting the workforce, but they keep announcing layoffs. And a lot of the layoffs are things that can be replaced with AI. So yeah, it's unprecedented times. I mean, a lot of people have tried to make this similar to when the internet first came around. And I don't know, the internet definitely changed things, but things just move. Like, in other words, instead of ordering things, going into Walmart and buying something, you're now buying it on Amazon. And that became a viable competitor in the retail space. But now we're really talking about jobs. And that was more about sales. And so I don't know. It makes me nervous. Okay. But you gotta see it and not fight it, because it's not going away. You can't legislate this away. You can't say, well, we're going to stop this. Well, if we stop it, China's not going to stop it, or the next man up's not going to stop it. And so I don't know how you regulate it to stop taking our jobs. And I meant that as a joke from a TV show, but that's true. There's a lot of truth to that. I don't know how you can legitly, once you let the cockroaches out, how you can herd them back in and try to make them, behave, if you will. So in this instance, today we have NVIDIA, and longer term have a bullish outlook on NVIDIA. It's the biggest company in the world at this point in time. And The big concern is that NVIDIA just keeps coming out with new chips, and there means that all these people that are making this huge spend might have to do it again, just like how you have to, go out and get the new iPhone every year. The new iPhone comes out, you got to buy it because your iPhone is getting clogged up and it's starting to, the battery doesn't work anymore. So we got to revamp and upgrade to the new one. And that's what the worry has really driven the AI stocks down is, do we have to continue to make this spend? And I think that's the biggest driver. Okay. Bottom line is I don't think that we can get short on NVIDIA. I think we have to get long because of where the stock is at. So let's run to the Tradier Pro software. And I'm going to start in the what if calculator. Now, this is my second trade. Let's look at the NVIDIA trade. And I'll send this to the trade ticket. But I'm just going to go a long skip strike butterfly. Try to take some of that premium or open wing butterfly. I thought about a skip strike and I kind of misspoke there. But I don't think the risk is worth the reward. I think I want to give myself a little bit upside. We can make this quite a bit cheaper by doing the open wing here from 20. Our middle strike's going to be 205, and we're going to go all the way up to the 215, and that's the way that we're looking at. And let's send that to ticket and. There we go. I got to hit send a ticket. There we go. Now we go over to trading. Let's look at the trade. So right now it's trading for about $5. So let's look at, we're going to go 30 days. And this is the thing, like I've kind of mentioned, is this isn't just an earnings trade. So if we do get to sell off, we're going to manage our risk by getting into the trade at a decent cost, and we'll hang around in the trade. So I'm not looking at this at trying to get out at, well, if I'm down 50%, I'm out. And that's not usually, if I'm going to put a butterfly on around an earnings report, realize that you can lose everything that you put into the butterflies. So in this scenario, we are $5.73. So that's $573. If the market goes down, be prepared to lose that. I don't know what's going to happen after earnings. And as usual, NVIDIA usually beats the analyst estimates and kind of set it up. But now the whisper numbers are, well, if they don't beat by 10%, I'm just picking a number out of the air. Well, then that's a loss because they beat so many quarters in a row that they now have established that. And it's almost like, okay, they're going to beat, but they need to beat by this amount for this to be relevant. Okay, so 185 to 205, going out 30 days, December 19th expiration. Buy the 185, sell two of the 205s, and stop shorten by one of the 215s. We're going to pay $5. We'll call $5.70. Let's make it, that's a simple number. I know that we could fill there. I think you can actually get a little bit better than that. But if you are looking at just buying the 205 outright, you're going to be paying $4.40. I guess it's a little less than the $5.70, but we're kind of looking at apples to apples. But now, if it doesn't make it to $5.40, if NVIDIA doesn't get to that level, well, you'd be or to 205, you'd be out that $4.40. You'd lose that money because implied volatility would crunch. We're active from the 185 level all the way up to the 205 level. Our break even is going to be 185 plus 5. So it's 190.70 is where our break even is at. And that's the move to the upside that we would need. And that also allows us to stick around to say, well, if NVIDIA can just get back to where it was, if we had a bad reaction to the earnings report, you still got a chip in a chair. You don't need it to come all the way up to the 205 strike. So comparatively to buying it outright, this is an interesting strategy. But now the downside is that if the market takes off and it does more than a 1 standard deviation move, we're right at 18%. This is almost a perfect 1 standard deviation move to the upside at 215. We have a minimal amount that we can make, right? So we're in the what if calculator. Let's go and check it out. We're in the what if calculator. We're at 186 or 185 is where the break even is at. If we're above the highest strike, it should be worth 10. We're doing a 20-point wide spread, and that's the long spread. The short spread is 10 points wide. 20 minus 10 is 10. So at this point, see where my cursor is on the screen, the butterfly should trade for around $10 at expiration. And the most and we paid $570. Oh, and it actually grabbed it right at $570. That's perfect. So 10 minus $570 is $430. So we could almost double. I mean, I guess that's not a true double. Well, we can make I'll just put it this way. We can make $430 if the stock just skyrockets. We put it on for $570. If the stock skyrockets, we can make $430 on our 1x2x1 butterfly. Our risk is $570 to the downside. Our break even is going to be right here at expiration, right at this crosshairs, which is the net debit paid plus the lower strike. So 185 plus 570 is $270. $200.70. No, it's not. It's $90.70. 190, and it's doing it just right. So this is our break even. I don't know where I got 200 from. So 190.70 is our break even. So yeah, we just need NVIDIA to do okay. And if it does great, we're fine. We're selling a lot of premium. We're putting on that trade. I would almost rather, people want to just buy one option contract and have the unlimited upside. I'd rather do a couple of these and as opposed to just buying one option contract outright and give yourself a good amount of upside. But obviously you can't hit the home run if this is the case with NVIDIA's earnings. So if you have any, I already see a few comments popping up. Oh, hello, Doug. Yeah, I did a similar trade. Go ahead and set that up. Oh, so you did the skip strike? Okay, next one contract, next one. 190, 200, 205 with puts. All right. For a credit, that's an open wing. Okay. Right? Doug, am I getting that right? Or I mean a skip strike. I'm sorry. All right, I'll put your trade in. 205, 200, 190 with puts. 30 days out, Doug? $200, 205. 2 days. Oh, nice. All right. 2 days. Okay. Well, I'll try to set it up. Let's see what we got. But you did it with puts. Is that correct? It's with puts. It's not with calls. 205, 200, 190. Yeah, that's a skip strike. But I would think, yeah, I guess you wouldn't get that type of credit. Okay, 205. You're going to buy the 205. And we're going to sell the 200s. And buy the 190s. There's your credit. That's what you said. Let's go look at it in the what-if calculator. All right. So in the money puts, now I would have thought about doing this on the call side of things, but I don't mind the profit and loss graph. You Okay, so now, yeah, okay, so now it's the credit. So basically, if you did this on the call side of things, Doug, you would be paying I'm guessing this is from 190 to 200. And you're getting $3. So you'd be paying a $7 debit? Bringing in that credit, and here's the problem with this is that we're dealing with in the money puts. That's not necessarily a problem, but in this instance, you might get put to well, after the expiration, you got to worry about having to buy and sell the stock, and you're on a very short-term time frame. Because you could set this up on the call side of things and not be as worried about being assigned on the puts. And so you want to close this out. You want to make sure that you don't get close to expiration, because if you do get, the broker's going to look at, what if I get put to stock at 200, right? And in that scenario, I'd like to trade. I like to trade, but I would have done it on the call side of things. So yeah. So this is the synthetic to something that we did. If you did it on the put side for a $3 net credit to the account, if they all expire worthless, man, it's kind of, we're going to be down below 190. We're going to lose $2, which is $5 wide. So the call side of things should be a net debit of $2. So if we flip this, let's see if I'm right. And we did a buy. Oh, I'm struggling with this. Yeah, so that's a $2 net debit. So if you go from the put side where you're bringing in the net credit, but you're dealing with in the money puts, you go to the call side of things. Now you're dealing with out of the money calls, which is usually a little bit tighter markets because there's less premium. And you now don't have to worry about assignment at all. You only have to worry. The broker is going to be a little bit more concerned about you getting put stock from being short the 200s on a 2-day trade. So here's the instance. You do this for a net credit or a net debit of $2, you pay for the debit up front, or you go to the put side of things and you receive a net credit, but then you're going to have a margin requirement. So I like the way the profit and loss graph looks, but I don't like it from the broker's perspective, because they're going to be worried. Like if the market goes down, they're going to be looking at these 200 strike puts with 2 days remaining. Yeah. It's a coin flip. Yes, it is. But it's, Doug, it's very similar to what we're doing. I just don't know why. I think I'd rather do it on the call side because, I'm just paying for it up front. No big deal. It's synthetically the exact same risk and reward. The biggest concern though is that you're selling an in the money put in this instance, and the brokers are going to have their eyes on it. And that's just and I don't mind if the brokers look at the entire position, because I've had situations with this where I assumed that somebody was at a webinar or at an event that the brokers would take the aggregate position on. And they don't always. Sometimes they just look at the one position that is a risk, and that's if you get assigned on 200 shares at $200 of NVIDIA, what the margin call would be. So then that makes me want to be on the call side of things where I'm really in control. And if the market like ends up at 197.50 on the call side, the 200s aren't a concern because they're going to expire worthless, but you're still in the money on the put side. But the risk reward is the same, if that makes sense. And good thing, yeah, I see that I will close tomorrow. And yeah, and here's another thing is I've done these strategies and I assume people would close them, right? In other words, I'm like, well, and I've had it happen. Well, I did that trade. It was very profitable, but I wrote it to expiration and then I got assigned on this leg and I didn't exercise this leg. And so it gets tricky. So if you get the profit, if you get the move that you're looking for, take the trade off. Don't worry about a nickel or a dime that you might not make. You got to put the trade on and take the trade off, especially around an earnings report. But I don't mind this at all, Doug. It's a coin flip. But I agree. You're right at 190. Market is up. If the expected move is, and I do mean that, I don't mind it. I just would have did it on the call side of things. If you get if you understand. Yep. And Doug said, I'll consider calls next time because then it's a net debit and you also aren't dealing with in the money puts. So you'll notice that, the spreads are a little bit wider. They're not bad because it's NVIDIA on earnings, but you're buying, you're like in this 205 call, you're buying a $200 option or a $20 option, where over here you're 108 by 109. You got 1 cent here. Here you're 10 cents wide. Now, no commissions if the market. So we did this for a net credit of $3. So what's our advantage? If the market goes all the way above 205, there's no commission to get out. Okay, so I had to, man, that hurt my head. I had to think about that. So the advantage in this instance is if the market did blow through your strikes, go above the 205 strike, all of these would expire worthless and you would make the $3 net credit. And then there's no bid-ask spreads, no commissions, no anything. So that's where there's always going to be a trade-off of using calls versus puts. And every strategy that you can do with a call, there's a synthetic relationship that you can do with the puts. It's the math of the marketplace. It really comes down to put-call parity. But you can, and actually it's just a little bit of algebra. If you ever work through everything, a little bit of algebra can tell you all of the synthetic relationships between a long, like a long call synthetically is long stock, long put, a protected put. You have limited and known downside, unlimited upside. You take that, you just actually move things from one side of the equation to the other, and you can come up with every synthetic relationship that is out there. Yes, you got it up moving. But so now if it goes down, though, these are going to get deeper in the money, and we have to close them. We have limited risk. We have limited and known down, but if we go down, we just got to make sure we close. So the benefit is if it goes way up, there's no commissions, nothing to close. Everything expires worthless. You make the $3. The downside is that if it goes down, you now have to close. If you're on the call side of things, you just let it expire worthless. And then you got commissions if it goes up. Straight off. Okay. So now my second trade that I like, and I like this trade. So I just went out 30 days. And so here's the difference that, Doug, you're doing the 2-day. I just worry about NVIDIA selling off to start. And I'm a bull longer term. And I own NVIDIA in my own account. NVIDIA and Google are two of my biggest holdings. What else? Oh, I owned Goldman Sachs, some of the financials. I still own a lot of Charles Schwab. Those are some of the bigger holdings. And then, of course, you own the Amazon. I own Apple. I've had Apple forever. A couple of regional banks. And that's where I'm at. I never did buy gold. I'm looking over here on my watch list. I never did buy gold. I meant to, but I never did. BlackRock at 115. So this is an interesting stock too. If we ever get some momentum back in the marketplace, BlackRock is a deal-making company. Thought they would do really well with the new administration, and they did. And now they've kind of sold off a little bit. All right, I digress. Let's go back and look at the what if calculator, and let's pull out Walmart. So this is a different trade. And I have to admit that somebody sent me an email and said, what do you think about this trade? So it wasn't my trade idea. I've looked at these before inside, and I should pull up the options playbook. Actually, I haven't done that in quite some time. Let's back out a little bit. Yeah, full screen. There we go. And I'm going to, this is actually called a back spread. And let me make this smaller. And here's the trade that I'm going to propose. I'm bearish in Walmart. Target announced the other day. Walmart didn't really move, which I was kind of surprised. Let's check it out. Let's go to the actual playbook view. There we go. Here's a back spread with puts, and this is the options playbook. So what we're trying to do is get this trade done. We're going to sell one expensive at the money put to pay for two out of the money puts. And we're going to try to get it done for a net credit. So another fancy term for this trade is a pay later put. We're going to sell this one to buy two of these. And the reason why they say it's pay later is, well, you're getting it done for a net credit. So if the market goes up, you're good. But if the market goes down, and it goes down, a normal amount, right? Within a one standard deviation move, well, then you got to pay later for it. And it's that simple. So you end up paying later for it. If it continues on down, though, you're long one extra put. You're selling one at strike B. You're buying two at strike A. So you have unlimited upside potential as the market goes down because you're long one extra put. But you don't pay for it up front. You're not just buying this put outright. So it's the reverse thought. And it doesn't always really work. Like we can look at it on the call side of things with NVIDIA, and it would be back spread with calls, and you just flip the script here. But on expensive stocks, the stocks really got to move. So it doesn't always apply, but every once in a while, I've looked at these trades, and every once in a while something pops up that looks interesting. It's usually on a little bit lower price stocks, but you're still talking about a big percentage move. So if we did it on the call side of things, let's go back spread with calls. It's the exact same profit and loss graph, but you're just flipping the script. Okay, so with NVIDIA, we got to go about a one standard deviation move out, and then you get rewarded for the huge move. So this is an alternative to just buying a call outright. That's what you would be thinking, where I'd be buying the B strike here, and if it doesn't make it to the B strike, or if it just gets to the B strike, I break even, or I lose the premium. So here, the benefit is that you do got some down. Like if the market goes down, as opposed to buying the call outright, the market goes down, you actually can make some money. All right, I like it. And it was brought to my attention via an email for Walmart, but I don't like it on the NVIDIA side of things. So let's look at both of them. Here's the Walmart trade. Let's send it to the ticket. Short at 100, from 100 on up, we can make a net credit of 30 cents. So if Walmart announces earnings and the stock goes up and say it moves the expected move to the upside, you make 30 cents. Market goes down, go down to 95, which is a 5% move, right? The math is really simple here because we're at 100. So that's a big move in Walmart after earnings. I mean, that would be the expected move is probably 4%. So your risk here is that you're doing what the marketplace is expecting to the downside. Your risk is that if the market goes here to 95 and it gets there by in the short term, then I have then that's where your max risk is at. Now, time premium can save you. Like in a butterfly, it's hard to max out when it hits your short strike early. Well, it's hard to lose the entire investment unless you ride it all the way to expiration. So the fact that we can go out 30 days in time, get this done for a 33 net credit, it's not quite drawn to profit and loss graph. It would be more of a loop in here. It would be like that. All right. Follow my cursor. The scope would go down like this and then come back up. We're not going to get to the TP, the top of the bottom of the TP until expiration. So if it goes to 95 after earnings, just be prepared to get out. You paid 30 cents for it. You're probably going to lose a couple of bucks. I wouldn't say you're going to lose the 5. I would guess somewhere between 2 and 250. But if you did get the double the expected move to the downside, well, then you have substantial upside as the market goes this direction. So I find that to be an interesting trade. Wish the what if calculator was drawn a little bit better profit and loss graph. It's showing it right at expiration. This is the night. I'm using the right expiration, I'm pretty sure. Let's go back to the what if and let's send this to the trade ticket and let's go to trade. Let's go to Walmart. And they're announcing tomorrow on the open. Earnings December 19th is 30 days away, and there's our trade. We're going to sell this one put, and we're going to use the proceeds to buy 2 of these out of the money puts. So the alternative, once again, would be that you would buy 2 of the 168. So you would have $3, we'll call it 160, we'll say $3.40 would be your max risk on this trade. And I would kind of say that that's really kind of our max risk on our trade, because if we get out on it on the next day, time premium is going to help us, even if it goes right to 95. The expected move is, well, it is $7. Wow, I'm kind of surprised. Well, no, because we're on the 30-day. So what's the expected move on the 2-day? Yeah, it's going to be 5 points, right? So that was a good guess, right about 4 or 5%. So let's add the expected move in. We're right at, oh, perfect. We're right at 100. Clear that out. Buy and buy. 520. 5%. Why am I doing the math? It's 5%. It's $100, 5%. So that's the expected move over the next 2 days. But here, if you want to do the screenshot, I don't mind this trade, but be prepared that if it makes the expected move only to the downside, you don't want to do it. If you think that Walmart can only go down 5 points, then I don't want to do this trade in this instance. You got to look for the big move to the downside. What do you guys think? Good morning, Kurt. Go ahead and throw that in there. So for example, if you were going to do this, this same type of strategy with calls, and it's not attractive. I'm just going to say that, okay? Because NVIDIA is a much high dollar stock. So the expected move on NVIDIA is for 2 days is going to be $13, right? So using the shorter term for earnings, we're going to buy this one and we're going to buy this one. $13 in that instance. So if you did this, you would sell the 65 and you would go about $13 and buy 2 of them. That's the only way you can get it done for a net credit. And then you would be looking for somewhere around a 20-point move to the upside to get excited about it. So in the playbook, this would be back spread with calls. You'd have a margin requirement. but it's not unlimited risk. And you would look to go out. I would still go out to 30 days because time is your friend. And then you're talking about 20 points. You can't go out 30 days because the expected move in 30 days is 22 points. So you're going to have to go 20 points down. So $11, you'd have to go 95. Yeah, $7. If you go 20 points and you buy two of those, the 195s are 730. That's 1460. And you'd only be bringing in a net credit of $11. Yeah, you would have to go real short term. And then you got that risk of you don't have any time premium and vol coming out. So you got 8 and 8, that's $16, 185 plus, so 260. That's okay. So here it is. I'm just doing all the math really quickly in my head because I'm going way long here. All right, we're selling this 185, going to 200. We're buying 2. Net credit. That's not right. Oh, maybe it is, huh? 270 times 2 is 540. Yeah, that's not horrible. If you wanted to do this one, and we could even go down to, I'm selling the 85 and I'm buying 2 of these. Could maybe do the 95, 97. I didn't expect this to be a good trade, but I'm not opposed to it at this point. So we're going to sell this and we buy 2 of these. Net credit of 150. So to the downside, you're 150. You got a margin requirement of $750. Send it to the what if calculator. And hopefully it's still not drawing up with the rate. But this is it. So one standard deviation move. What did I say it was? What's the one standard right after earnings? Well, that's fine. So now this is a pay later call. Market goes down. If the market goes down, you make 145. You put up 750. The difference between these strikes would be your maximum risk all the way down here. Your loss should be there it is right there. 1,100. Oh, it's 12. I did the math wrong again. Dang, I had a degree in math. It's 1250. All right. So it's 1250 to the downside. So from here to here, it's 1250. And then the one standard deviation move in that time period is about $20. So you need it to go all the way up to here. But remember, to start with, you're looking like something that would go like this. As time decays, it starts every day that goes by, it's going to go down until it gets to the precipice of the downward mountain. And then that's where the risk is at. I thought it was 750. Why did I think it was 7? It's 1250. So that changes it once again. But it's not a bad trade. It's not horrible. I like our trade better. All right, I got to go. I got another event that I got to partake in. What do you guys think? What do you think of the Walmart one? I'm tempted on the Walmart one to do that to the downside, mainly because we can go out 30 days, and that time premium will protect us after earnings. Even though vol is going to come in and it's going to crunch, it will protect us. So it's a trade. The Walmart back spread is a trade that would that you don't expect to hit a home run on, but you might. So I have limited risk, and if Walmart were to tank, which it's a high valuation, the odds of NVIDIA moving 15% is a much higher chance than a Walmart moving 15%. Walmart is Walmart. there are a lot of red flags in the Walmart report, but Walmart's a very well-managed company, and it trades at a premium to valuation, and it's probably because of the management. They are one of the largest grocers out there right now. So that is a big part of their business, and it's growing. That's where we're at. All right, gave you a little bonus time today. Go NVIDIA. Let's get this earnings report out of the way so then we can get into the holidays and start talking more about Amazon and Walmart and Target and Santa Claus rallies and eat some turkey. You know, life is good. So we'll be back Friday, and we'll look at the trade on Friday. We were going to do a short today, but I talked him out of it because I did want to look at my NVIDIA trade. I almost always do some types of earnings play around NVIDIA. Thanks for stopping in. See you on Wednesday, 11 a.m. Eastern time inside the Tradier Hub. Don't forget to thank Tradier. Open an account. Check them out. They got a very good platform, very good people over there at Tradier. And reward them for the amount of effort that they're putting into trying to give you great content. My name is Brian Overby. Check out optionsplaybook.com if you want to look into some of these ratio spreads, and talk to you on Friday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.